Experts are now predicting or forecasting an increased chance of a recession in 2025. Tariffs and federal and private sector layoffs are driving this souring economic outlook. Even President Trump refusing to rule out the possibility of a recession this year. What does it all mean? Well, financial professional Nathan Ford from Vital Retirement Planners joins us right now to talk about this, about a possible economic downturn. Okay, so when the president says, I'm not ruling it out, that's not a really good sign that investors are saying, man, maybe I should hold on.
Well, it doesn't give us a lot of warm fuzzies.
Right.
But I think, to be clear, we're not in a recession right now. And people are looking at those indicators to see if we're moving toward one. A recession, by definition, is 2 consecutive quarters of negative growth. We got another quarter, basically, to go to see if we're there in a recession. There are some concerns with layoffs, job losses. You know, in February, we added 150,000 jobs, but we lost 172,000 jobs. So we're
down
negative.
Okay.
In February, which caused unemployment to uptick a little bit to 4.1%. There's some concerns about tariffs increasing the cost of things, and when the cost of things increases, consumer spending tends to slow a bit, and that could impact a lot of different things. But everybody's just watching carefully to see what's going to happen.
And don't watch.
Or don't.
Your 401k, which you don't. There is sometimes you should do it, but again, these are paper losses until you sell them. It's just stock. If you don't sell them, you don't actually lose the money. What do you recommend people do with their 401ks right now?
Well, it's funny you say that, because it can be painful to look at it, but we believe clarity is better than just guessing at what's going on. You want to make sure you're diversified in your portfolio. Make sure you're diversified across sectors. You're diversifying risk. You want to hold investments that don't all act the same way when the markets change.
Not all in tech, not all in things like that.
Right. So spread yourself out, and ETFs are a good low-cost way to do that. If you have a good investment professional that you can meet with to get an analysis of how you're doing, now's a really good time to do that. But one thing you want to be very careful of is just getting out, jumping ship, get out of the market.
Right.
We don't want to do that, because you can miss out on some really, really good rebound days that you're going to need.
And so you were talking historically, the numbers you had earlier kind of shocked me. Tell the people at home what you told me.
Yeah, an interesting study came out. It showed, looking at the last 20 years of the market, if you missed out on the best 10 days, not 10 weeks, not 10 quarters, 10 days, the difference would be that at the end of that 20-year period, your investment balance, your account, would be cut in half. If you miss 20 days, it's down by more than 70%.
Wow.
And many of those best days take place during times like this, during bear markets.
Right. People are scared.
Be careful. Yeah.
Right. So long story short, hang in there. And perhaps if you see an investment that's worthy, maybe even buy more.
Yeah, exactly. And if you're close to retirement, you got to be a little bit more careful to make sure you're not taking a lot of risk, you're not accepting a lot of volatility on money that you're going to need to withdraw over the next couple years to sustain your lifestyle.
I wish we could talk. We're out of time, unfortunately, because I would love to talk about the tariffs and the cars. And my daughter's turning 16, and who's going to buy a car now if they're $70,000 each?
I'll sell you one.
No. All right, we'll be back in a couple minutes. Thank you so much for your time. Appreciate it.